Hi, I'm Paul Higgins from Build, Live, Give, and I'm here to give you another great episode of Corporate Escapee Experts. This is where we get experts from all over the world to come and help people that have left corporate and are looking to build their own business, live a great life, and give back. And today I'm very excited to actually have one of our community members who's been giving lots of support within our Boost community, and I know he will add lots of value in this webinar today, or this podcast today, I should say. So welcome, Ben McAdam from benmcadam.me.
Thanks, Paul. Thanks for having me.
Yeah, look, it's great to have you on. So why don't we start with a little bit about your background? So why, and sorry, I should say that you're an expert in finance, so a virtual CFO, which I know a lot of people hear a lot about but don't understand a lot about. So that's why we brought you on today. But yeah, why don't you start with a little bit of background as how you got to be a virtual CFO?
Okay. It actually started in my teen years. I had two major obsessions with my time in high school. One was playing classical piano and the other was business. Some well-meaning relative gave me a copy of Rich Dad, Poor Dad, and then it was just over from there. Now I don't think that the book is as great as I did when I was a teenager, but still it started me on the path. It was the lead domino. And I decided that, okay, what should I do for a career if I want to be involved in business, and realized that being an accountant, you see everything that happens in the business. Everything is tied to the numbers. The accountant records so much of what's going on. And so I went in and did that. Started with a suburban tax firm, worked in a mid-tier accounting firm in their super division. So that was my taste of corporate. And that was absolutely the opposite of what I was looking to do. So left that, had a couple of financial controller roles in businesses that were like 1 to 5 million in revenue, and that was more what I was looking to do. I was in a position where I could contribute to the strategy of the business. I could help keep an eye on expenses, help with whatever they need to grow sales, and help people understand how the numbers contributed to growing profits. Then after a few years doing that, I was thinking of having a child, and realized that I would need to work from home if I was able to spend a lot of time with my daughter when she was young. So back to a suburban tax firm to tick off the last couple of boxes to get my tax agent registration, and then opened up my own tax bookkeeping and virtual CFO business around about the time that she was born. And that, it was really helpful having that time. I'm really, really grateful that my work allowed me to do that. Since then, she's now 4.5. This is a while ago now. Since then, I started a bookkeeping business with another guest you had on the podcast, Meryl Johnston. We started the bookkeeping business, Bean Ninjas, and then after about 18 months of pretty rapid growth, I sold my share to her. And she's continuing to do great work with the business. I'm very happy about that. And then I was also running a tax practice, but I'm transitioning out of that at the moment because I much rather focus on the virtual CFO services. The tax work has served its purpose of giving me more time with my daughter when she was young, and now getting into the virtual CFO work, which is much more my passion and has been for years now.
Great. And when, as I said before, a lot of people hear the word and they don't really understand what it means, a virtual CFO. So you walk into a party and someone says, so Ben, you're a virtual CFO. What does that mean? How do you answer that?
I usually say that I'm like a strategic advisor and a right-hand man for anything to do with your business finances and profits. Or to put it another way, say you go to your tax accountant and they do your tax return, they give you these lovely reports like a profit and loss and balance sheet and all these other names you might not really know what they mean. I'm the kind of accountant that will actually use those reports to tell you how your business is doing and how to make it better. I don't just use them to fill out a tax form.
Great. And I know the analogy often used is like driving, where you look through the windscreen 80% of the time, the rear vision 20% of the time. I get the sense that's a bit like what you're doing. You're actually helping people look at the future and how they can improve their future profitability versus looking at what's happened in the past.
Exactly, yeah. And there are some special reports I help people put together, like a cash flow projection that we can talk about a bit later, that much more future focused, and what's your business going to look like in the future, and how we can do something about that now.
Right, and if someone's listening or watching this and they're thinking, look, I'm not comfortable about the numbers. A lot of our audiences, we're in corporate, where they understood the numbers, but they always had someone there helping them, whether they had a business analyst or they had someone else to really dig into the detail. And then all of a sudden, they're busy doing sales, they're busy doing delivery, and the numbers are sort of something I'll get to that they don't get. Now, what sort of size of business can start to see real value from hiring someone like yourself?
Anywhere from low six figures of annual revenue. I usually find by that point, the business owner has sorted out how to get customers. They've validated their service or product, that there is actually a demand for it in the market. And then they're starting to think about growing, or they're starting to think a bit more about the future and turning it from less of a job more into a business, hiring a team. And about that low six-figure revenue mark is about when they can get value from working with someone like me.
Okay, great. And what are some of the common objections that you see, or the common problems, I should say, that you see with people with those businesses when it comes to their finances?
There's three, actually, three big ones. Number one is that after, like I said, once they get to low six figures, they might feel like they're working really, really hard, but they're not actually earning much money for all their effort. And maybe they've tried hiring someone to help with all that hard work they've got to do, but that kind of makes it worse. All of a sudden, they're earning even less. Yeah. That's a really, really big pain point, and fairly common in the low six-figure range. Everyone goes through that experience. And if you haven't been in business before, if you haven't got an advisor, you don't know that one of the main reasons, or the first place I would go to find out whether you're solving that, is something called margins. Sorry to use a technical term, but it's a quick way to refer to it. And it's the difference between what you charge for your product or service and how much it actually costs you to deliver that product or service. And if that gap isn't wide enough, then your business is going to feel like a lot of hard work just all the time, and you won't know why. There needs to be enough gap in there for plenty of money in there for marketing, plenty of money in there for your other overheads like your office rent. Needs to be plenty of money in there for investing in the growth of your business, like hiring team members slightly before you need them, so they're trained up in time for when you do need them. And also having a little bit of extra margin in there to pay ourselves as business owners. We're not in this for just for fun. It's important to make a profit. So having enough of a difference between what you charge customers and the cost for you to deliver that's the big thing. So the magic number there is, if the cost of delivering the product or service is 1/3 of what you charge customers, that's a pretty easy rule of thumb to keep an eye on. If you can aim for that, then you'll usually find there's plenty of money to grow your business and pay for all those extras that I was mentioning.
Great. And what are some others?
So other pain points, not knowing whether they'll have cash, or whether now is a good time to invest in hiring a new staff member, or starting a new project, or doing a big marketing investment. And that goes back to what we mentioned about the future focused reports and the cash flow projection that I said. So sometimes it's called a cash flow projection, sometimes it's called a cash flow forecast. But the idea is it's an estimate of what your cash is going to look like in future months or future weeks, if you want to look on that granular level of detail. But it's a basic safety mechanism to see that you're not going to run out of money if you do something now, or you do the cash flow projection and you see, okay, in about 3 months' time, we're going to run out of money. So now you can do something about it. You've got 3 months to make a difference to that. Usually I will do a cash flow projection showing the next 6, sometimes 12 months in the future. And we put all the major expenses on there. Like if you're a product business, then every now and then you have to pay your suppliers for a new set of inventory. So we'll make sure we put that in the different month columns. If you're a service business, or even if you aren't, and you have a team, we put all their costs and their payroll costs, some of which are quarterly, like superannuation for the Australians listening. That happens every quarter. We put the quarterly taxes, we put the annual taxes. And so you can see maybe this month there's lots of money in your bank account, but part of the reason why is because you've got these quarterly bills coming in the next 2 months, and all this money in your bank account should be kept there to make sure that you've got enough money to pay for it. So the cash flow projection, and I've got a template on the website. I'll give you a link a bit later. But the idea of the cash flow projection is you can see I'm not going to run out of money, or you've got enough notice to do something about it. And you can also put stuff in, like add an extra line for a new staff member or a new project, and see what effect that has. So that's a pretty important thing. And the third pain point is just that business owners are getting reports from their bookkeeper or their tax accountant, and they don't know what to do with them, or how to understand them, or what it's saying about their particular business. Maybe they do have some corporate experience looking at them, but the reports for a small business will look a bit different for the ones from a corporate business, or maybe they haven't had to look at the whole picture before. Maybe they just dealt with a certain area. So not understanding those numbers is a big issue, and there's a couple to keep an eye on. Revenue is obviously good. We want that going up over time. You want to keep an eye on the margin, like I said. So the difference between how much in revenue you're charging your customers and how much your cost is. So keep an eye on that margin. It may be written in your reports as gross profit. That will be the dollar difference between your revenue and your cost of sales or cost of goods sold. If you don't have a cost of goods sold and a gross profit section in your reports, talk to your bookkeeper and tax accountant and ask them to put that in, because that's the easy way to have a look at your margins. You divide that gross profit figure by the revenue, and that gives you the percentage, or that rule of 1/3, or the 3 times difference that I mentioned earlier. So 2 big numbers, that's revenue and keep an eye on your margins. And then the other point is keep an eye on your profit. If it changes from 1 month to the next, go look at all the different rows in the report, find out what is responsible for that change, what else has changed from 1 month to another, excuse me. And then the final thing to use those reports for is you look at all the expenses. It might be listed as overheads or operating expenses, but it's the ones that aren't directly related to providing your product or service to your clients or customers. And just keep an eye on those expenses, make sure they don't get out of control. Or if you're spending money on something and it's working, then maybe you might want to spend more on that particular expense. But you can use the profit and loss report to keep an eye on all those numbers.
Great. So if I sort of summarize, one is, drawings, not having enough drawings, not paying yourself. 2 is around cash flow and future workflows of cash. And the 3rd is around understanding the reports. And I think certainly for our community members, they're some of the key challenges. I just want to ask you a couple of questions before we go into the solutions on how you might solve those. Firstly, around the drawings perspective. So I know a lot of people don't factor in a wage for themselves. So they say, yes, I'm making all this money. I say, that's great. So what are you paying yourself? And they say, well, I don't pay myself, but I do okay. And I say, well, actually, that's not how it works. So as a rough rule of thumb, as a percentage of revenue, like, is there a figure that you look for to say, what should you be paying yourself in drawings on a monthly basis?
Yes, actually, and it's a combination of two things, and this is an important concept that most people don't intuitively come up with, and it's the idea that you actually are wearing two hats. You are working in the business just like any of your other team members, and you are the owner of the business, and this business is one of your assets that you hope to get a return on, just like if you owned a rental property or if you own some shares. So I usually say that the ideal we work towards is you want to pay both of those people an amount that they're happy with. So you want to be able to have, say, a 10 to 20% return for the business owner, and that would be like 10 to 20% of the revenue. That would be a good return on investment that you, the business owner, would like. And then also, whatever you're doing inside the business, whatever your job is, your role is, you should be paying yourself market rate for that, because one day you will have to replace yourself or part of yourself for those things that you do. If your business is going to grow, you can't continue doing everything. So that's the ideal we're looking for, is a return on investment plus market rate for the work you do. It's not always possible, especially in the beginning. So I usually say that if you have to make a choice, work on increasing your wage up to a market rate, and then you can worry about yourself as the investor a bit later if you need to. But again, like I said, if you have margins right, then you should have enough profit in order to pay yourself that way one day.
Right. And how do you determine that market rate?
Just go onto a job board and have a look at what people doing a similar role are being offered. You should eventually, it's a good idea to have like a organization chart for your business, and you're going to put your name in all of it, in all those positions initially. This is an idea from the E-Myth book by Gerber. I forget his first name.
Michael Gerber.
Michael, thank you. I was going to call him Roger. Anyway, it was an idea he said in his book, and the idea is you then start filling all those positions in the org chart with somebody else. And if you've written that, then you know what your position description is, and you can then go look at a job website or Google a salary guide or something and find what that rate is.
Okay, great. And around the cash flow, how many months of operating expense do you recommend to have in the bank at any one time?
Somewhere between 3 and 6 months. It depends on the particular business, and it depends how conservative the business owner is. Like, some people are really happy to take massive risks, but I will force them to put at least 1 or 2 months of cash aside. And then there are people who are on the other end of the spectrum who aren't comfortable with anything less than 12 months in a separate bank account. And my job is more to push them on that comfort zone and say, can we shorten that to 11 months, and then we'll have this extra capital that you can invest in growth and improving your business.
Yeah, great. Well, I know the rough rule of thumb we use is 3 months, so I'm a little more aggressive, I suppose, than the 6. But I think it's really important. And when we come in and look at whether it's some of the Boost member or Titans member, one of the questions we first ask is how many months of cash do you have for operating expenses? And that question is normally, it's a lot lower than 3 months, and that's something that we look to build. So I think that's a great benchmark. And around the reports, you talked about gross profit margins. So for a service business, which most of our community is run service-based businesses, what's a rough rule of thumb or a benchmark at a GP level? Is it 60%, 70%, 80%? Like, what's some thoughts on that?
Yeah, 67%. So 1/3. Usually it's an easy number to calculate, and that number I didn't just pull it off the top of my head. Accountants and lawyers have been using that for many years. With their billing rate system is usually the way they work out the billing rate for any of their staff, and therefore how much they charge their clients for that staff time is usually a 3 or 4 times the total payroll cost of that particular employee. So that's an important thing to underline, is it's not just the hourly rate you pay them. It's also, you've got to factor in the leave and the superannuation and workers' compensation, for the Aussies in the audience. All those extra costs have to be included. Plus, if you're going to do any training for them, and you also can take it a step further if you like, and consider the fact that they may not always be doing billable work. They may be doing some admin work, even if it's just filling out their timesheet. So factoring that in as well when you're calculating the billing rate or the margins.
Yeah, and look, a lot of our community use subcontractors, so people all over the world, like you, I suppose, as a virtual CFO rather than a permanent, which is, the great part of having that flexible workforce. So which costs do you have in your cost of goods sold in a service business, and which costs sit below that in your indirect costs, as I call them? I'd love to get a bit of guidance.
Sure. Yep. So the cost of goods sold section should be all of the costs of delivering a product or service to the customer. So if you're a service business, then all of your staff who do the work that you charge your customers for, all of them should be in the cost of goods sold section. All of your admin team should be down below that gross profit line, in with your other overheads and operating expenses. Same thing with your marketing team. Unless you're actually providing marketing services, then your marketing team, your admin team, they should all be down below. If your managers do billable work, then their billable time should be above that line as well. But part of their job will be simply monitoring the team, and that bit should be below the line. Sorry,
Ben. So if you've got a business owner, like take, for example, myself. So I do some advisory, I run the community. So I've got some of my income, some of my expenses in my time is direct billable, and then others is running the business. So, should I split, or should I just have my wage, completely below the line? I'm always interested to know what I should do in a situation like that.
Yep. You're one of those special cases in the grey area that because you're the business owner and your personal effort will probably always be a part of the business. So I would say it's up to you about how granular you go with this detail. There may be other ways for you to keep an eye on the fact that you're spending your time wisely and that you're earning enough. There may be a different method. But for other people listening in the audience, you could split it. Say, for example, you pay yourself a wage. You could have your bookkeeper or whoever's entering that wage in the bookkeeping system. You could say, all right, I spent half of my week doing billable coaching calls, and I spent the other half of my week just running the business. And then the bookkeeper could use that rough percentage and split your payroll entry that way.
I suppose the key point, which is I think what you're getting at, is that as long as you're benchmarking the same way, so there's consistency in the way that you're treating it. And I always say to people too, don't spend too much time making it so complicated that from you actually getting more revenue.
Yes, absolutely. Yeah.
Yeah. Great. All right. Excellent. Well, look, there's some great challenges there as far as the solution. So when it comes to improving your margins and making sure you're paying yourself right, what are some of the key things that you recommend a business owner does to improve that?
Yeah. So the main thing with margins, the two pieces of information you're looking at is how much you're charging your clients and how much you're spending to deliver what they're paying you for. So have a look at what you're providing. Make sure that it's really efficient, particularly if you're a service business. Have a look at your processes. There's probably some wasted time. If you've got a team, make sure they're productive, because the more they can get done in the hour that you're paying them for, then the lower your costs will be. So wasted effort and productivity there, that's an important thing to keep an eye on, but also see if there's services that the client is paying you for, but they don't care if you stop offering those. You could be putting in a lot of effort for something that they don't really value very highly. So keep an eye on that as well. So that's kind of like a reducing expenses perspective, and that's what most accountants usually default to talking to you about. But part of my difference is that I will actually have spend quite a bit of time on the sales side of things as well. What can you do to grow your revenue? In particular, in this case with the margins, we want to grow the amount you're charging a customer for the same delivery cost. And so sometimes that's just, I ask, when was the last time you raised your prices? And someone will say, oh, 3 or 5 years ago. I say, all right, it's time to do that. You should be doing that every year, because every business owner will understand that your cost of delivering the service will inflate over time. So regularly raising your rates. Make sure that you're pricing on value instead of just on cost. Like your service provides some value to them, and it's probably quite a bit more than what it costs you to deliver it, particularly if you're good at what you do. So make sure that you're actually charging them what your service is worth. That's another big thing, particularly for newer business owners. There's always that self-worth question about how much can I charge. There's that mindset thing always needs to get past that. And then there's other ways to raise how much you charge a client. Extend the amount of time you do the work for them with. That increases their lifetime value. Bundle in some other things, add some extra things into a package that cost you barely anything to provide but give you an excuse for a higher price. All these things, suggestions can work for most businesses.
Yeah, I think that's a great point. I think so often, I think, you know, simplicity of new clients, existing clients. I think people don't break their revenue into those two buckets.
Mm-hmm.
And like you said, under new and existing, it's like ways that you can offer additional services to increase that revenue pool. And someone once told me that, you know, obviously the top of the P&L is a lot more, contributes a lot more to your profit than the bottom. So if you can increase the revenue, you're going to be, you don't have to work as hard versus reducing costs. So reducing costs is important, and automation and all, I completely agree, but I think most people leave money on the table, like you said, through not offering people the right services, not by pricing them at the right rate, those things. I think that's really important. Some great suggestions there. As far as cash flow forecasting, we sort of talked about 3 months. I know that we've had lots of banter and boosts around, you've given lots of really good information around how you can improve your accounts receivable. What are some ways that you believe you can improve your accounts receivable position?
Yeah, that's a good point, because we've talked a little bit about improving your income and expenses in a profit and loss, but with the cash flow projection, the important difference with that is it's the timing, and you have to pay your customers might pay you at any point, and you've got to pay your suppliers and staff at some different time, and the difference in there can make or break a business sometimes. And like you said, one of the big ones is getting your customers to pay you on time. I wrote a blog post with a few ideas, but the basic idea is get them paying you sooner. And sooner is always better than later. In fact, it's so much better than later that you can offer them a discount if they pay on time. Usually it's only somewhere between 1% to 3%. I've seen 5%, but I probably wouldn't advise my clients that that's necessary. But offering an on-time payment bonus is a good incentive. So that's kind of like the carrot. And then the stick option is that you penalize them if they don't pay on time. And there's lots of ways to do that. You can hit them with late fees and late interest, but make sure that's in your contract initially. You can't just add that later after they've been late. So penalizing them with late fees and interest, withholding your goods or services, depending on what you actually do for your clients, how critical you are, that can be a incentive that works all the time. If, say, for example, it's a manufacturer and they need goods from you to produce products and fulfill their orders, then if you stop supplying them the goods, then they should pay you pretty quick. Consistency is a big thing. Make sure that you show the people you mean business about chasing up the debts and collecting them on time, and do that consistently, and then your customer will remember that, and you'll, over time, you should have to chase them a little bit less. And part of the way you do that is make sure you send your invoices on time as soon as humanly possible. Send them progress payment invoices and don't continue the work until they pay. Send statements as soon after the end of the month as possible. Send it via mail, send it via email. The beauty of sending via email is that you can add a read receipt to your email, and you'll know that they've opened it, and they can't just lie to you and say, oh, I don't have that invoice, because you can say, well, actually, I can see in my system that you opened that email. So Xero, the accounting software, Xero, has that feature that people can click a link in the automatic email, and Xero will record that, the date and time. So being on the ball with invoices and statements is a big thing. Then calling them really quickly, like once the debt is, say, 2 or 3 days late, to allow for delays in the post or bank transfers. Get on the call with them. It'll be a nice first call, because you don't want to annoy them at this stage if something reasonable is happening on their end. And then get a commitment from them. Say, all right, when is this going to be paid? It's already late. Can you make it sooner than that? And then write down that amount and say, okay, I will give you a call the day after that if the payment hasn't come through. And then do that, because then they will know that they're going to keep getting these calls, and you're pleasant and professional, but they could do with not having these calls in their life. And knowing that you're consistent, you will follow up when you say you will, so that when you eventually threaten them with legal action for non-payment, they know that that's not an empty threat, that you will carry forward with it. They will get in some trouble, and when the lawyers get involved, you can add extra late fees and interest if the debt goes to court. So that's probably the main tips. I could keep going, but I'll keep it short for the podcast.
Yeah, no, look, I think that's good. And I think, no, even I know in large corporate, very few cases ever go to court or get sued. So I think, you know, the biggest thing around here for me is the timing of when you charge. So one is charging 100% upfront if you can. If not, charge 50-50. And that second 50%, it should be based on a milestone date, not on a completion date, especially for a lot of services, whether it's website development or whatever. If the client can't give you back information and they're busy, that's fine, but that doesn't mean that you should bankroll them. So if you've done your end, and you've done your commitment, it's a milestone date. It's not a completion. So many often people say, you know, 50% upfront, 50% on completion, and then the blog post never goes out, or something happens which is not for you as the supplier. You've already done your work, you've paid your subcontractors, and all of a sudden that's where you get a cash flow issue. So I think that, and the other one is, you know, making sure that it's a recurring income model as much as possible. So not having to invoice, not having to chase it up. You can get a recurring model. That's why we love memberships as an example, and subscription based, where you don't have all that administration and headache, and it saves time both ends. So look, some great suggestions there. The last one around reports. So what are particular, you know, if you had to give 3 specific solutions on a report you should be looking for, whether it's Xero or your QuickBooks, what are those 3 things?
Yeah, so the main report to look at is called the profit and loss statement or income statement. That's the main one to look at. And I mentioned a bit earlier about keep an eye on your revenue, your margins, and then keep on top of all your other expenses so that your profit over time should improve. So that's a big thing to do. Compare it to previous months, a few previous months at a time, so you can see trends. You obviously want positive trends over time, and you want to spot a negative one and do something about it. So don't just rely on the annual report from your tax accountant. Get a bookkeeper or yourself if you really must, and do it monthly. If you want to do it weekly, that's good too. But still, even if you're looking at your reports weekly, also look at them on a monthly basis so you can see the larger macro trends, which might not be visible when your head's down in the weeds. So that would probably be the main tips. And then the last thing I want to mention is there's another report that people don't tend to look at called the balance sheet. And with the way bookkeeping works is that a number is either on the profit and loss somewhere or it's on the balance sheet somewhere. And if you don't have a good bookkeeper or tax accountant, there could be a lot of errors on the balance sheet. Numbers that should be on the profit and loss or shouldn't be on the profit and loss that should be on the balance sheet. So if you're just looking at the profit and loss and thinking, oh, I'm going great, it could be because there's a whole bunch of expenses accidentally put onto the balance sheet. So we're looking for errors there. But the other point about the balance sheet is it has all your assets and liabilities. So it's kind of like your wealth. The profit and loss statement is your income and your earnings. And then the balance sheet is like the wealth of your business. And you want that going up over time as well. Because the bigger a buffer you have between your assets and your liabilities, the more sustainable your business is and the more it will be able to capitalize on an opportunity that might come up. So your assets include things like your debtors, the amount of money that your customers owe, and you should be keeping an eye on that number. You don't want it to go up faster than your revenue does because it could be a sign that all your customers are starting to pay you a bit slower than they have been, and you need to take steps to fix that or account for it in the other things you do with your business.
Great. And what happens, I often get the question around car leases, so people taking a car lease through the company. And, you know, is there still if you take a car lease, can you still get the $20,000 instant write-off, or how does a car lease get treated in a P&L versus an asset?
Yes, that's an important point to mention, is that if you buy an asset, the whole cost of that asset might not necessarily show up as an expense. So you might feel like you've got a bit more profit, or your profit figure might look really good and you think, why don't I have that amount of cash? Well, it's because of these things like the assets and the loans that are the difference between profit and cash. So an asset may be turned into an expense over multiple years. At the moment, there is the $20,000 write-off in Australia. So if it's $20,000 or less, you can write it off in the first year instead of spreading it across multiples. That may change in future years, but just keep in mind that the cost of the assets that you've paid for isn't necessarily being reflected in your profit. And then the other thing tied to that is that there may be a debt associated with that asset you bought. Maybe you didn't pay cash. And in that case, the debt will be sitting on the balance sheet, and that's a future amount of money you're going to have to part with. So make sure you'll have it. And the loan repayment itself, not all of that appears as an expense either. Only the interest component of it will reduce your profit, but the amount you're paying to reduce the debt will only appear on the balance sheet. So that's another case where you've got less cash than you think when you look at the profit line in your profit and loss report.
Okay, great. And what are some of the common myths that you see around financials? I know you've covered quite a bit today already, but what are some of the common myths and some of the things that, you know, catch hardworking entrepreneurs out?
Yes, yep. I touched on just briefly there is that looking at your profit and loss and your profit figure may not be the same thing as the cash you have coming in and out. So that's often a big question people first encounter when their tax accountant gives them a report showing how much profit they have. and how much tax they have to pay on that profit. And then they turn around to the accountant and they say, where's all that money? I don't have this money. Where's the cash? And so that's an important thing, is that profit isn't quite the same thing as cash, especially as your business gets bigger. So that's something to account for. Another big one is that the thought that no one can help with this sort of thing. And I mean, I understand where it comes from. The bookkeepers generally focus on data entry and producing the report. There's very few of them that will actually give you some business advice on them. Usually that's outside their training. Then like the tax accountant will do the report, but only to fill in the tax form. So they'll give you these big stack of papers, ask for your signature on them, and then they're moving on to the next client without giving you any business advice specifically. But there are people like me, virtual CFO. It's not a hugely popular term, but there are quite a number of us out there that can help with this sort of thing. So that would be one myth, is like you can get help. And it is an important thing for you to spend time keeping an eye on. And then the other myth is like there's too much maths involved, or like I don't want to deal with ratios, or people have horrible memories of maths from school and they just don't want to deal with anything that's to do with numbers. But like I've said throughout this podcast, I haven't really gone into very much complicated maths at all, and you can do quite a lot with just the suggestions that you and I have talked about on the podcast, Paul. It's just those couple of basic numbers that need to be kept an eye on. So it's really, really basic level of maths. I mean, I can go into ratio analysis if a particular client wants me to, but my first thought will always be, is this actually going to be valuable for them? So I will push back if someone says, oh, should we be doing ratios? And I'll say, no, you really shouldn't. They're not useful for you. It's just a distraction. Let's keep things simple. You can even even if your bookkeeping isn't up to date, there is still, you can look at your numbers in different ways. There's a lot more you can do if your bookkeeping's up to date. So I definitely recommend doing that. But even without that, you can still think about your margins, about what it costs you to deliver your service and how much you're charging for it. So yeah, they're probably the big ones.
Great, and you may have already covered these, but when you talk to business owners and they say, Ben, what do you do? What's a virtual CFO? What are some of the reasons why someone won't go ahead with a service like yours?
There's two reasons. One is they're not sure whether it will work for them. I mean, usually a lot of my clients come in via referrals, so they have a really good testimonial saying, yes, this worked for me, Ben did this, go talk to him. But for some people, they don't really know if that's someone that I'm someone that can help, or that anyone could help. So I've got testimonials on my website to try and help with that. But mostly I just say, look, the first call is free and I will give you help on that call. It's not just like a sales pitch in disguise. I will give you a sample of how I can help you. And if we don't work together, you'll still be better off. That kind of risk removal thing. And then for like, if they're still not 100% sure, there are some smaller initial services I can do, like analyzing their reports, or just having a shorter initial call to deal with one particular issue with their numbers. And I'll sometimes offer like a refund. I'm like, okay, you're not sure if it'll work for you. If it doesn't, I'll give you the money back. And that usually helps people. So that's number one reason why, is that they're not sure if it'll work for them. And then the number two reason why is a bit of self-sabotage for my clients. They're either not comfortable with success or growing their business, or what the next step might be, or they might not feel like they're worthy of a better version of their business. And so there is a little bit of self-sabotage that I sometimes have to help people through as part of my work, not just trying to convince someone that I can help them. So that would probably be a big one too. So I usually ask people before I jump on the call, I have a big question like, do you actually have the resources to implement my advice? And that's kind of a hidden question that gets them thinking about the future. And if they're going to self-sabotage, it happens then instead of on a call with me. Though I would prefer they're on a call so I could help them with it.
Okay, great. And as far as the relationship you spoke before around a bookkeeper, an accountant, so some people sometimes feel as if 3 people in finance is too many. And what's the relationship? Will my accountant get upset that I've got a virtual CFO? Will that? Now, my accountant sort of said that they're going to provide that, but they haven't. Sort of, how does that? Have you seen that in any situations? And if you have, how does that sort of play out?
Yeah, it can get a bit complicated depending on the particular people involved. Like bookkeepers are usually used to doing the data entry and making sure all the reports are okay for someone else to deal with. Like most bookkeepers are used to having to hand that off to a tax accountant. So the bookkeeper is usually not the problem in the piece, unless they're really slow, or they're not a good bookkeeper. That's the only issue there. It's not so much an interpersonal one with them. The tax accountant, some of them want to do what I do, and sometimes can feel a bit territorial or jealous. And in that case, it's usually I tend to back down from those sort of things if the client is happy with that particular tax accountant, because I don't want to disturb something that is working for my client. So in that case, I'll usually give way to the tax accountant. If the tax accountant's terrible, then usually the client says that to me right up front, and they're looking for a new tax accountant as well, and can I recommend someone? And there are 2 tax accountants that I work with, and I can usually refer them to one of those. And obviously, I know a good bookkeeper. The Bean Ninjas, I'm still pretty proud of what they do. But I also have other bookkeepers I refer to if the client isn't a good fit for what Bean Ninjas does.
Okay, excellent, great. Well, look, that sort of takes us to the end of our session, Ben, and I hope people have got a good understanding of sort of the key challenges that people face, which we certainly come across them all the time. Drawings, not having enough, not paying yourself, cash flow, that real timing from when you get paid to when you pay other people. I think that catches a lot of people out. And then some of the reports, like you said, thinking they've got all this profit when they see a P&L, but not understanding that deferred expenses or what have you. So I think, they're common challenges. I think you had some great answers here. And, if people want to find out more about Ben, they can go to benmcadam.me /BLG. We'll have all the resources there ready. So, so Ben, thanks for being part of the community. I know you're always so willing. There's a lot of people that say they'll give you a free consult, but it is normally under the disguise of trying to sell you into a program. But Ben is a really honest guy who lives the values of our community. And if you really want some help with your finances, which I think is critical in helping you rapidly grow, I highly recommend Ben. So Ben, thanks a lot for coming on the show today.
Thanks, Paul. Really had a great time.
Excellent. And if you want to find out about more experts like Ben and the other 130 people that we've got, basically I listen to about 2 hours of podcast a day at 2.5 times speed. I'm always looking for experts like Ben around the world. I interview them. We go through a process, an application process, and when we know they're the right fit, we then get someone in the community to use them. And once they've been used, we then basically have them there for you, because we think that finding the right experts is probably one of the key things. If you get that right, it will certainly reduce the time for you to grow your dream business. So if you want to find out more about that, you can just go to buildlivegive /boost. And you'll see the link there where you can join our fantastic community, which I know Ben and I enjoy being part of. So once again, Ben, thanks a lot for being on the podcast today, and look forward to your continued support in the community.
Absolutely. Great to be there. Thanks, Paul.
Thanks, Ben.